Welcome to another episode of the Real Estate Market Minute. My mission is to help you better understand the latest trends in the U.S. real estate market and share with you my analysis and industry expertise. I want to help you gain an advantage and feel confident whenever you're buying and selling real estate. I'm your host, Mark Salib. I'm a passionate real estate professional, advisor, and investor, and I love what I do. Follow and DM me on Instagram at The Salib Group. Send me an email, mark@thesalibgroup.com. And as always, thank you for tuning in to today's show. Today, the Federal Reserve announced that they are keeping interest rates unchanged. So what does that mean for the housing market and mortgage rates going forward? Well, let's talk about it. So what happened? So Federal Reserve Chairman Jerome Powell announced no change in interest rates. What I thought was interesting was the Q&A after the fact. Powell's core message in the Q&A is that policy is already restrictive. There's no urgency to cut rates, and the Federal Reserve needs more confidence. Inflation is coming down before they can do much, and they're quite comfortable where rates are today. Translation to me was rates higher for longer, and that's my base case and has been for quite some time, and it was just reiterated today to me. So a couple of key points. One is I thought that they were in no rush to cut rates. They made that pretty clear. They also indicated that energy prices are elevated due to rising oil, and that's making inflation even more of an issue. Right now, Brent crude oil has actually been rising over the past week. That's not good because we had quite the drop in oil prices all the way down to under $100 a barrel, and now we're right back up above it, sitting at right around $108 a barrel. It does move quickly, but that's where we are. And the fact that the Federal Reserve is in no rush to cut rates, that obviously impacts the housing market. It means mortgage rates should remain elevated, or at least in the range that they're in, right around that 6 to 6.5%. Affordability, therefore, for housing is going to stay pretty tight, and it should limit buyer demand for the most part, at least at a national level. Now, the fact that oil has been rising, I find interesting because, we've been getting a lot of these messages coming out of the White House that things are going okay, that there are talks between Iran and the United States, and that ships are freely going through the Strait of Hormuz. But I'm getting the feeling that the market is starting to sniff out something else, that perhaps this conflict might get reinstigated. And whether oil is actually going to flow freely through the Strait of Hormuz might not be that obvious, because why is oil going up? All right, rising oil, higher inflation, right? Higher inflation, higher bond yields, and then you get higher mortgage rates. And that's where we are, and that's where we remain. So even with the Federal Reserve having paused today, mortgage rates, remember, they can still move higher. But we'll see. It all depends on the macro environment and what we see next. All right, another point. Now, the labor market. Jerome Powell talked today that the labor market is still very strong. Jobs were still solid. He even talked about how the economy remains resilient. So again, when it comes to housing, that just means folks have their jobs. They tend to not be in any dire situation to force sell a home. That's good. That's good for the housing market. All right. I want to talk about something that I've noticed, and that's this disconnect between two different markets. So one is Wall Street, right? As we know it, the stock market, the bond market. But especially I want to focus on the stock market. And I want to talk about the disconnect between what we're seeing in the stock market being at all-time highs and what we're seeing in what I call Main Street, which is basically, the economy and how people live their lives every day and how they feel financially. Now, while the stock market is at all-time highs, why is the average middle-income household apparently struggling financially? And why don't they have much confidence financially? Why do they think housing is still largely unaffordable? All right, well, let's start with the stock market. Stock market being at all-time highs. Look, it's 60% of the stock market at this point is technology driven. 50% of it's dominated by just a few mega cap technology companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, right? Google, Meta, Tesla. Yeah, we have an AI boom going on. They have strong earnings, they have huge profitability, and they're moving the market. They're moving the S&P 500 with them. Now, I wouldn't let the stock market be your cue on what's happening in the real economy or the housing market or affordability, because Wall Street does not equal Main Street. And I'm going to tell you why. Let's look at this. The University of Michigan Consumer Sentiment Index. If you haven't heard of this, what it does is it measures how the average American consumer feels about the economy, about their own finances, and about conditions in general when it comes to buying assets. Now, why I bring this up? Because the reading in April came in at one of the lowest readings ever. That's right, one of the lowest readings ever from the University of Michigan Consumer Sentiment Index, which is a very widely followed index for how the consumer is feeling. So people feel worse financially. And when they feel worse financially, what happens? They get a lot more cautious. They tend to delay major purchases, and housing is definitely one of those major purchases people just might delay, right? Housing is very sensitive to something like this. So listen, if you're holding assets, if you're holding stocks, if you own a home, you're feeling pretty good, right? But remember that when it comes to just bill paying and average households, they're struggling, right? They're struggling to make ends meet, even though they may own a home or own stocks, right? And so to me, it's why I think, or at least I think one of the major reasons, the housing market just isn't moving much, right? It's just kind of stuck. There's not a lot of pending home sales. You don't see a lot of movement because the people who might actually want to buy really can't, right? They feel stuck. And so that limits demand, that limits buyer demand. And that's why we're seeing, especially, when I just covered the home builders index recently, and it showed, that consumers, builders basically told you, home builders told you that buyers aren't coming in, right? Consumers, buyers, home buyers are not coming in. They're not walking through the door. They're not checking out model homes. It scored extremely low on that index when it came to home builder confidence on the part about buyers and whether there's buyer demand. All right. Bringing it all together. You got a Federal Reserve not cutting interest rates. You got oil rising. You got inflation risks still very present. You got mortgage rates staying elevated. And you got a weak consumer sentiment. Well, that's going to keep housing demand pretty constrained, in my opinion. And remember, the Federal Reserve, they're not trying to fix the housing market. It's not their goal. They're trying to control inflation and maintain a strong job market. They have a dual mandate, and that's it. Control inflation and make sure the labor market is strong. That's what they're focused on. All right. I just want to close with this. As far as what happens next for mortgage rates and housing, I just feel like right now with the situation with oil, inflation, and even with sentiment being so low, it's telling me, first of all, I think rates are here to stay higher and for longer. I think, unfortunately, buyer demand may stay weaker for longer than expected. And I just think that's the situation we're in. I don't see anything clearly in sight that's going to change that right now. I actually have a concern with the way oil's been moving lately. That really, really bothers me. And that, I can tell you, will impact all facets of the economy. And it definitely won't help interest rates. It won't help housing. It won't help the stock market. It won't help any of our pockets, really, right? With rising energy prices. We're paying more at the pump. We're paying more for airline tickets, energy bills, all that, right? It's not good. It's not a good situation. And I really do hope it improves, but we need an end to this saga between the U.S. and Iran in order to get that improvement. Until we get that, I think this is exactly where we're going to be. And it could be here for a while. But you never know. Let's see, and let's continue to hope for the best. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time. Before we end today's show, stop what you're doing and subscribe right now to Real Estate Market Minute Plus. Listen to all episodes ad-free, get exclusive bonus episodes and content, and help support the show's growth, longevity, and future improvements. Go to realestatemarketminute.supercast.com right now. You can also find the link in this episode's show description. Check it out. I know you'll love it.